Morning, everybody. February 27th, it's 9:35, so we're going to do about a 30-minute run through right now. Kind of state of the markets for a Friday as we wrap up the month, looking at rotation, looking at momentum, looking at a handful of other things like insider buying. I hope everybody's doing well. Thanks for joining me today. We're going to try to start to get some of this stuff live at some point, hopefully post-market moving into Thursday or possibly even Friday. We're going to talk briefly a couple of things today. If you're getting the Capital Wave report, I want your feedback, obviously. If you're not getting the Capital Wave report, I don't know what you're doing. In addition, this is for my audience that at Postcards as well, in addition to our insiders side. I'm going to show you guys a couple of tools that we're going to be unveiling soon as well. One for Capital Wave. Postcards is going to have to kind of hang out for a little bit. I apologize. But Insider will have its own platform as well soon, just so that everybody can take advantage of some of the tools that we've built in recent weeks. So you're going to see the labor versus capital thing. That's going to be a subject I'm going to bring up just simply because it is going to be very top of mind in the wake of the news around Block. But let's just dig into that. Cutting 40% of its workforce. And I'm going to give Dorsey a little bit of credit for doing it all at once rather than through multiple rounds. I've worked for public companies where they've done 3 to 4 rounds of layoffs, and it is bad for morale. But the stock is up 20%. Forgive me, this chart is a little bit off right now. And as we move into the morning, this is going to be a stock to trade today, largely through volume-weighted average price. You're going to look at some pops, some drops. Keep a very close eye on that 24-minute adjusted 3-minute chart and 60 minutes. So if we roll over, possibility of a move down to 58, 56 during the day. But that said, cutting 40% of the workforce, AI will require fewer people. And since it is Jack Dorsey, if it would have been Zuckerberg, it wouldn't matter. It gives a lot of people permission to do this. And it opens up that debate once again, right? What is the most important economic debate of the last 250, 300 years? It's labor versus capital. And I don't point this out with a dog in the fight as an economist. I've read enough political economy in my lifetime to put everybody to sleep at the same time, so I won't bore you with anything from the 18th, 19th century. But I will point out that, once again, the reality is that every hire is part of a company's portfolio. And some people make the company a lot of money. Some people don't do anything. Some people steal $4.1 million in credit cards. You can look it up. The point that I'm making is that less is done with more, or more is done with less, however you want to define it. And the reality is that these companies are going to make the cuts that are necessary in order to maximize profitability. That is within their ethos and within their rights. But it is going to open up these conversations and these debates again about rights and labor and, whether or not people have a right to employment. And it opens up a big question, and I'm not going to get dragged into any of this. My commitment remains the same. It is focusing on where capital will flow, where the opportunities emerge. But it is a reminder that, hey, working for yourself has a lot of benefits. And once again, in this environment, it is going to be a pretty radical shift. I am not a doomsday person in this, but I will note that there will be a radical realignment. And this is going to be a major trend. It may not be the political story of 2026, but it certainly is going to be very critical in the 2028 elections. We continue to focus, and we have the new Hedge of Tomorrow report coming out next week. The focus here is on where is capital flowing, where are the opportunities. And if you're an employed person and you're a person working on a day-to-day basis, you need to know how to AI-proof your resume, AI-proof yourself, where are the right investments and where are the opportunities ahead in kind of person-focused, non-AI disrupted industries. We're going to talk a little bit about that in the report. So a little bit of a mixture of opportunity for investing, but also opportunity on how to position yourself personally over the next 2 to 3 years. On top of that, the trader focus right now, again, I'll pull up the individual futures market coming in 10 minutes in from the market. We're down 1% on the S&P 500. Russell's down 1.5%. The VIX is up 6%. And as I've said, give me that VIX 25. That's kind of where my focus has been. We went long on this yesterday. And the key thing I just want to note is we've shown that chart over and over again. When the VIX kind of settles down into that 17 range, it has woken back up. And right now, All that chatter yesterday, all that noise about, oh, is the private credit issue over? Is the private credit crisis over? Guys, it's not over. And for anyone who was in my chat yesterday, when we did that competition, I talked about some people will try to convince themselves that the bottom is in for a company like CrowdStrike. Once again, this was the winning stock that I was talking about. 20 times sales, unprofitable, margins negative, return on invested capital negative. I'm not touching this stock unless they massively print a lot of money or this stock falls 75%. It's the only two ways I'm touching that. And meanwhile, everybody is ignoring Blackstone Minerals, which is extremely capital efficient, extremely strong margins, cheap, looks great, and once again, owns the mineral rights to the very thing that powers AI. And I just want you to remember this right now. We're looking at gold right now. We're going to talk about gold positioning in oil and what's happening with China momentarily, but this is the focus right now. The VIX over 20, 15% moving under an hour off the channel bottom. If this keeps up, the floor becomes 20 for a little while. It is creating real tangible ranges for mean reversion, top to bottom. And once again, we have to keep a very close eye on the FNGD. There it is. Back above those key moving averages. Back above that 8. Back above that level. That 50 is going to be critical to pay attention to. I will just simply note that on the daily. We're on the weekly chart real quick. I apologize. So we're back above that 8-day moving average. And as I have said, nothing good happens in markets when the FNGD is over its 50-day moving average. This is a fund that teaches us a lot about deleveraging in the Mag 7 stocks. And as somebody pointed out yesterday, the HIBS, the high beta inverse ETF for the S&P 500, another thing to keep in mind as well. Watch that 20-day EMA as well. We're kind of weak. We have our signal at the moment, Capital Wave, and one of the tools that we are building, hello, look at that. Isn't that beautiful? This will be available to Capital Wave readers very soon. This is our signal. It is active. It is live. And once again, this signal, when it has gone negative, it kind of raises some deep concerns around the state of the market. And this is about reversion potential, reversion to the downside, reversion to the upside. Remember, this figure went negative February 21st, 2025. Market crashed 6 weeks later. In addition, this went negative on August 1st, 2024. 4 days later, the Nikkei fell, largest downturn since 1987. Went negative February 21st, 2020, 3 weeks before the real bad start of COVID really kicked in. It went negative on March 7th, 2023. 4 days later, Silicon Valley Bank didn't exist. It doesn't mean that every time that it goes negative, the market is going to crash. It just simply is a reminder that it going negative is a sign of leverage leaving the system, momentum slowing down, liquidity creating some challenges. So in this environment, and we're going to talk about how bad this market could be if we were not pumping somewhere between $525 and $650 billion into the market right now, I'm just going to remind you, we are in a very uncomfortable environment, and I'm going to explain why this market feels so uncomfortable momentarily. On top of this, PPI today, we did get some numbers, and I do have a chart on this, so give me one moment, and I will pull that up. I do want to point out a couple of things that came out of this update yesterday, or forgive me, this morning. The most important thing out of this is the very fact that we got into a very interesting move with a 2.9% jump on the figure. And why does that matter? It matters because, as we have seen, inflation is coming back. It's coming back. All right, so here is our update on PPI, the January 26th snapshot. Down 0.3% on final demand goods. That fell. That's good. Gasoline down, energy down, food prices down. And again, you take that, strip out the things that actually matter, food and energy. Well, how wonderful for us. The bad is that services continue to jump. Largest jump since July 2025. Trade services margins have increased. Core PPI, X food, X energy, X trade is still elevated. Ninth straight months rise in core persistent pressure. The wow is this: search and navigation systems, defense demand, drones. Did we write about Kratos recently? Did we talk about the demand sequence of all of this? Defense spending, this is telling you right now at the beginning of the supply chain where capital is going to be flowing and where capital formation lives. Pro-commercial equipment wholesaling margins up 14%, down 12% on system software publishing. Well, I wonder if AI has anything to do with that. And raw milk's down. Hey, I don't know to be excited about that or not. Once again, S&P 500, this is the capital wave focus here. These are our screamers and our crashers. Stocks today, look at Netflix. Netflix was on the right about 2 weeks ago, breaking down. And obviously on the news that they have walked away from a potential deal with Warner Brothers. They have now moved into number 2, and they have screamed higher on this news. And it's one of those things where I was early on this. I was trying to get this to revert. I was in it at 84. I stopped out at 80, and it just took off. And that's just how trading works. You move on, you keep tight stops. I was hoping that this was going to happen about a week ago. It did not. But here we are. Dell's got a nice move. We're going to keep a very close eye on Dell because of continued momentum. Remember, when it comes to momentum, it does not just happen in a day. There is no efficient market thesis. So Dell popping up to 141, what's going to happen now? Other investors are going to potentially chase this higher. They're going to see those AI demand numbers come. And then what happens? Well, analysts start to make upgrades. Money starts to drift, and it's going to find its range not in the next 2 weeks, but probably in the next 3 to 12 months. That's what the academic data tells us about momentum situations. The rotation is real out of tech cyclicals, comm services. We're going to talk about that in terms of how the monetary cycle operates. But for right now, just recognize that we are witnessing continued strength here. Keys, HWM, Corning. I mean, I've been all over Corning. This has just been pure momentum. And we're looking to make another move, potentially back to 160. On the downside, it's all the financials still. CoStar still under pressure. APO under pressure. These are the worst of the worst. And we have a lot of tools. We have a lot of things that we get to play with now. We have an options calculator. We have an AI displacement figure. We have a conviction engine. We have a massive insider buying log now. Oh, that's wonderful looking, isn't it? I don't have to pay for that ever again. Texas Pacific Land got a bid. TPL at 510 just came in. We're long. Gotta like that. Gotta like the reaction to the news as well, right? So buyer's log, anybody over at Insiders, you're going to get access to this relatively soon. We're still doing some bug testing at the moment, but this is pulling directly from Form 4 documents. So we've got here, again, you can see SEC Form 4 goes right to it, scraping, pulling. That is going to be in addition to our insider report in the weeks ahead. Everybody who is at Capital Wave, you will be getting access to this, right? The Capital Wave figure as well. And then we're going to open up Triple's dashboard and our conviction engine at a later point. This is based on multiple momentum types: short-term momentum, long-term momentum, and anchoring in value. We did a triple balance on this, and this gives us conviction as well for continued momentum and continued breakdown in the markets, combining the works of Grant Henning, J.P. Morgan, Cliff Asness, and Wes Gray to create a version of Frankenstein for exactly the types of things that I'm looking to build. And we will continue to focus on this and continue to test it and look for best opportunities as they emerge. We've got some updates here. We've got a confirmed bearish. We've got our signals. And on top of that, we have the Russell 2000 as well. So universe of Russell, universe of S&P 500. Gosh, I love being able to code now. Oil's up. Iran talks, no deal yet. Well, let's see if anything has really changed. Not really. We're actually even higher, 3% move up. That's good for our favorite names like Land Bridge, TPL, APA. That's where the momentum is. On top of that, looking at the nuclear talks. Don't put too much caution into this. Don't spend a lot of time trying to speculate to the upside over what may happen. Obviously, the Strait of Hormuz is in focus. The key thing I want you to just do right now is just have a deeper understanding that if we wake up on Monday and there has been an escalation, we could be even more risk off relatively quickly. So this is a day to position yourself accordingly. Sell calls. We're already negative on momentum. We're already negative on the S&P 500 and the Russell. So we're seeing some jitters. Key headline movers right now, the 10-year dropping below 4% for the first time this year. Ahead of that data, Paramount clearing the path for a $111 billion deal on Warner Brothers. Apollo's BDC, this is a problem, joining Blue Owl and FSKKR in reporting loan book strain. And I'm going to pull this up right now. This is going to be something that Tim Melvin owns in the future. He's working on some data with it right now. But the key thing here, I just want to point out, we're looking at stuff that's really beaten up, really beaten down. And it's a lot of banking stocks, right? And that's the stuff that we're looking for reversion. This combines the quality value. This is a Buffett reader. And this is insider buying. And this is just kind of like capital efficiency mixed with the possibility of, can these stocks revert? Well, right now it's a lot of BDCs that are beaten down. This stuff looks cheap. And unfortunately, I'm not touching that. FSKKR is a pretty good group, right? And you could see high probability of reversion, but the Buffett numbers are ugly. The value numbers are kind of gnarly, 296. And as we dig into this, we're starting to see some cracks, some real cracks in these asset management companies. So it's hard to really have a lot of optimism at the moment, trying to look for reversions there. See, Kratos is moving on the, I love this company. I love this company. 7% drop today. It's continuing to bleed off a little bit. This was a recommendation that we had over at Postcards not too long ago. Special offering, $1.1 billion in proceeds. I'm a buy the dip guy here on this. I also like selling spreads down here on this as well. Underwritten at 84. You're going to see a lot of insider activity on that. 10% discount. Defense spending theme continues despite the delusion. And keep in mind, we just saw a lot of money on navigation systems on that PPI figure. Where is that going? Once again, drone warfare, everybody. That is the real story. That is the real lesson of what's happening over in Ukraine. 15 miles of no man's land right now. And that is going to be the future of warfare. All the things, the big tanks, the aircraft carriers, this is going to come down to control, possession, and cheap drone warfare. Retail investors are piling into beaten down software at near record levels. Good luck. I'm out. Again, I'm going to continue to allow that trend to play out. But gold holding at 5,200 and silver at 90 has nothing to do with U.S.-Iran. It has everything to do with monetary policy. Insider buying, not too great. Not a lot going on here. We talked a little bit about what we have in terms of some of the tools that we've put together. We're going to add about 9 or 10 of these things. We've got insider buying activity in Washington, D.C. that we're building right now. We're looking at a full lobbying chain that we're going to analyze as well. But right now, key days, we can go back we're going to be able to go back a couple of days. We're currently building a site that will be insiderbuys.com, I believe. We'll have that up and running relatively soon. But just to show you the functionality, again, this is just pulling directly from these sites. And one of the key things that we are making sure that we do is we focus on that key insider role and over $100,000 in spending. Particularly, I want to be looking, obviously, at CEOs and CFOs, but this is just the stuff that has come in and has been reported this morning. Top sale, $35 million out of Meta. Doesn't really matter that much, but context logic, keep an eye on that. Now, everybody wants easier policy. The math says no. The IMF says that there is room to cut. The Fed has room to cut to 3.25 to 3.5. But the same report out of them warning U.S. deficits running at 7 to 8% of GDP. Debt is on track to hit 140% by 2031. 2% inflation now, not until 2027. Remember, it was 2021 that Jerome Powell said that we would be at 2% by 2025. That goalpost moved last year to 2027. It's going to be very tricky to get to 2%. but we could see it pretty quickly. This is going to go gradually and suddenly, particularly if AI becomes as deflationary as I expect it will be in labor markets. I think it will pick up. I think it's going to obviously impact a lot of different things, including wage growth. But nonetheless, remember, AI is a highly deflationary event. The other element of this is we still have a big debt deflation problem, and if deflation starts to rear its head, they're going to print money. The supply problem is, again, we have this tariff issue that's going on. The government may have to pay back $133 billion in refunds. That money's got to come from somewhere, and it's most likely going to come from more Treasury supply, particularly at the front end of the yield curve. The 10-year has slipped. It's really, we want to focus on 3-month to 12-month Treasury bills, and that pile of debt just keeps growing. It keeps growing. But do note that deficits are part of the broader liquidity puzzle. Our landmine today, we had the PPI number already. There's still going to be a lot of focus on AI disruption. eBay, Cigna, Amazon also cutting. It is a story of haves and have-nots forming. I'm not apocalyptic on it, but it is a trend, and it is a story. And it does matter because it's going to creep into politics, social elements. And one of the things that I continue to stress, I'm going to talk about it here really through the lens of how it impacts your individual business, you as an individual, as an employee, and what you can do to be successful. We're going to talk about that stuff at Postcards. But here, it's really about where are the investment opportunities? Where are the things that there's still potential to squeeze out of this? What are the companies that are most likely to cut? That's going to be pretty easy to determine over time. But more importantly, what are the things that you cannot disrupt? What are the choke points in the economy that AI can't do anything to? And that goes back to our Postcards portfolio. The pipeline companies, the toll booths, the roads, the businesses that, again, no matter what happens, whether it is massive disruption in war or deeper concerns about what's happening with AI, these are things that cannot be automated away. These are the choke points that historically people have owned. The wealthy families during Judea, during Rome, during the fall of empires, during the French Revolution. It's all the same playbook, and it's largely what sovereign wealth funds invest in. Key choke points, inflation-proof choke points, and most recently, as I noted in the most recent Postcards, I talked a lot about where do we sit in a world where AI disruption may impact negatively our workforce. Keep in mind, our entire Social Security system is funded by human labor and taxes on human labor. They don't have a solution to this yet. And I doubt that it's going to become some profitability issue that they're going to start pulling out of individual companies. I don't think they're going to have the political ability to do that. It's going to be large conversations about how do we reform the system. That said, what did I say on Sunday? What I talked about was the very idea that we have massive levels of people in America who are going to be moving on to Medicare, Medicaid, Social Security. And where is the money going to continue to flow? Where it is obligated. It's obligated to go into these rails, into that mandatory spending. And where does that take us? It takes us ultimately to medical REITs, senior living. And you're going to notice a theme here. I had a conversation with somebody recently. They said, where should I put my time and attention now if my job is going to be disrupted? And I said, are you good with people? Go work with seniors. It's AI proof. Now, whether that's working in medicine or working in counseling or even just volunteering your time, like the reality is that's where capital is going to continue to move. And they're going to print money to do it. And they're going to expand the monetary base to do it because they vote. So once again, we're looking for those different types of opportunities. We recommended a medical read around that over at Postcards. And we're going to keep our focus there. All right, on top of that, the private credit strain's not going away. The FOMC and the BOJ March convergence. The BOJ is what matters. I'm not paying much attention to the Fed right now. It really is the Bank of Japan that has really kicked up so many problems for us in the last year and a half, going back to that August 2024 hike that ultimately led to their massive decline, largest downturn since 1987. We've had multiple rounds in this. As I've shown, every time that the bonds in Japan fall, and they fall sharply, go back to January 21st, their 2060 bond was trading for 38% on the yen, 38 cents on the dollar, however you want to define it. AIG got crushed. And you're going to notice that every time that Japan engages in some sort of monetary support form, AIG stock goes up. AIG has exposure through a sale of a business to Nippon. January 21st, there is where the bonds bottomed out. Here's your rebound. Here is the November print when they printed 117 billion. AIG turned right back around and popped 12 points. Here is the 2024 period, right? Big downturn. AIG rolled right back after that monetary policy accommodation. So pay attention to Japan, because every time that Japan does something accommodative, AIG does well. And any time that that the Japanese bond market is starting to spasm again, AIG is showing some pressure. Look at that deal. It's 20% of a business that they sold. They still have some exposure there. Treasury oversupply hang is critical as well. Real quick, I'm going to make this just very down the middle, right? This is the truth. Any business that you go and you work for, you are part of a portfolio of employees. And the difference between what you produce and what you generate is kept by the company. This is not, a bearded fellow talking in 19th century. This is just political economy. This is the way that systems work. And we're going to have a deeper conversation about that. And again, if you hadn't had a chance to look up Lost Dog with our friends Tom Sosnoff and Mr. Sheridan, they are helping out with individuals who are looking to, figure out what their potential value is in any market in the United States. And the same for investors with their portfolios. So I'm going to throw that link into the bottom. Check out Lost Dog. You get a free year subscription to portfolio analysis and to helping people really identify what their market value should be anywhere in the United States. In addition to that, they're giving out up to $50 in crypto. Again, just pointing it out. No dog in the fight. Just going to say this is going to be the debate of 2028. All right, this is my last point before we wrap it up today, and you're going to read this in postcards. Or not postcards, forgive me, money printer. I tried to do some math last night, and I gave up. I just gave up. I tried to figure out, based on where we've been in the last couple of months, where the S&P 500 would be if the U.S. Federal Reserve and the Bank of Japan were not engaging in monetary support. If they were not printing money, if they were not engaging in stimulus, if they were not pumping repo, if they were not doing everything that they possibly could to prevent instability in the markets. I had a couple of different scenarios, and I've looked at different models in the past, and I've seen other people do this, and they've said, well, if we had not done quantitative easing, unemployment would be at 14%, and we would have had a 12% downturn in GDP. And I say, well, that's all based on assumptions. And I gave up. I just gave up. I just threw my hands up, and I said, this is stupid. But I do point out, this is what has happened in the last couple of months. They ended QT, which was a $60 billion a month runoff that went down to 20, then went down to 5, then went down to 0. So there's no bonds hitting the market. Reserve management purchases are at $55 billion a month. I had initially seen they started this at $20 billion. They went to 40, and then really what Cross-Border Capital has pointed out, it's at 55 a month. And they're saying it's not QE, which is adorable. They lifted the emergency window. It used to be $500 billion a day. Now it's completely unlimited. They've had 3 rate cuts of 75 basis points. Once again, rate cuts don't matter. The SOFR is what matters, not the Fed funds rate in this ecosystem post-2008. And the leverage ratio changed. And I forgot about this. They freed up $220 billion at the 8 biggest banks to do what? To buy U.S. Treasuries, to help suppress yields. Meanwhile, the Bank of Japan, 40-year yield above 4% for the first time ever. $41 billion in bond value was destroyed in a day. They've cut the long-term issuance to a 17-year low. They're focusing on short duration, same game that we're playing. They're rewriting the accounting rules so insurers don't report losses and have to sell bonds, which would lead to higher interest rates. They stopped hiking rates. They're debating on this. The prime minister is pressuring the Bank of Japan governor, and they injected $117 billion in extra spending stimulus back November 21st. $170 million in trades triggered a crash in a $7.3 trillion market. So it ain't the trades, it's the market itself. And what's underneath all of this is private credit, $1.8 trillion to about 3.3, depending on the figure that we've seen a couple of different places. UBS has said the possibility of a 15% default rate. 1.3 trillion. That's low end to non-bank lenders. Blue Owl gated the investor withdrawals. Bloomberg compared this to the BNP Paribas fund freeze in August 2007 before the entire financial system started to unwind. And if private credit blows up, it doesn't stay contained. These connections are built into the system across counterparties everywhere. And keep in mind, a lot of this stuff is just completely and totally unregulated. Big banks originate the loans, but they're not responsible for holding this stuff on their balance sheet. Thanks a lot, Dodd-Frank. Now, Michael Howe is aligned with this. He wrote about it this morning, saying that the Fed's liquidity is actually up 5% since the start of the year, 20% annualized over 6 months, and he's got $525 billion in extra liquidity injected into the money markets in 3 months through policy. I'm at 650, he's at 525. Howe's saying the Fed is not just running monetary policy, it's underwriting liquidity in the world's biggest debt market, and a large balance sheet isn't a whim, it is now essential stabilization because the shadow banks can't get this from traditional financial ecosystems. This stuff has to come through larger origination points. So the key thing here is the question that I ask is every support mechanism is employed. We're doing everything except from just straight up QE, but we are doing a form of QE. We're just not calling it QE. It's called reserve management. Thanks. The Fed's buying, the emergency window's uncapped, Japan is spending, the bank and accounting rules have been changed, both here in the United States and in Japan. And what does this market look like without a $650 billion or $525 billion in support? And what happens when it is not enough because the private credit hole is a lot bigger than what I think a lot of people think it is? Private credit risk is elevated, the defaults are rising, range bound at best through 2026. The banks are starting to say UBS has gone neutral. Everybody came out at the beginning of the year and said 7,800, 8,000. And I was sitting here saying, guys, this is very comparable to 2022. The rotation out of tech and financials remains in play. Crypto is showing us right now that liquidity and leverage is not there. The FNGD continues to showcase once again that there is ample weakness in a lot of the tech names. At FNGD, as I have said, nothing good happens above that 100 and that 50-day moving average. That's leverage unwinding. Micro sectors, our good friends. And where's the opportunity? Well, again, rotation into resources, energy, utility, staples. This is where the bulk of the postcards portfolio lives. And defensive sectors benefit from that later liquidity cycle. People will start to move into duration, start looking mid-range, maybe looking at bonds right now, right? Go back to the old school view of Ben Graham and think about, what are they paying? What are they paying? What are the bonds paying? And if the bonds are paying this, what should I buy the stock at based on a price to earnings ratio? If it's 6%, they're paying 6%, then the PE ratio should be 8.5. Now, I'm not going to necessarily align with that from momentum, the way that I think, but like that was the way that markets used to operate, or at least that was the expectation. And if we get into crisis, that's the Graham motto. That's what he did back in the early 1930s before writing Security Analysis and making all of his money back after a spectacular crash. 80%, 90% on the S&P 500? Nah. But somewhere in that 20 to 25% range, what we saw back in 2022, that's definitely plausible for the end of the period, the end of the liquidity cycle. And I will note that even though they are doing a lot of support, keep in mind that in 2007, 2008, the liquidity cycle actually was at a top. And then it went sideways real fast. Real fast. So this is why it's important to pay attention to our signal, why it's important to hedge, why it's important to rotate, why it's important to actually get your fingers in the ground and buy real assets right now. Gold and silver still looking good. And once again, Japan, China, a lot of focus. Hedge funds have been moving money into Japanese equities, into Chinese equities aggressively in the last month. That was evidenced by some charts over at CIS Group. The PBOC is injecting. Let me remind you something. When we do QE, that benefits our banking sector because we're financialized. When they do QE, it benefits manufacturing and metals. So they are providing not a floor, but at least support here in the world of copper, gold, silver, and other materials, lithium, etc. So be very aware there. Finally, just to walk you through a couple of things, we have the SEC tool that we're building right now. Capital Wave dashboard is nearly done. That will likely operate just through my site. We have a displacement index on hiring right now that we're building. We have an options calculator. Thank goodness. Fantastic to have this. This is going to help us with insider buying trading. We have a multiple reversion system that we're setting up, looking for breakout opportunities and breakdown stocks, looking to continue with trend. We'll have a presentation on momentum relatively soon. Value reversion, this is going to be Tim's in the future. Conviction, this is an engine of multiple different tools, insider buying, various types of things that we want to continue to keep our eye on. Looking for screen changes, looking for opportunities as they emerge, combining value with momentum where relevant. Sectors, all types of different tools. And fragility, this was a big one. Actually taking the academic focus on fragility, what is fragile in the market, and what could potentially break down very, very quickly, bringing that all down to a number and an index. Finally, last thing that we have is, of course, the insider buying log. This will be available relatively soon for our insider buying report over on Substack. If you haven't checked that out, that's our smallest list. But we write every morning. We talk about the top buys of the day. We're going to make this, a little bit more automation so that people can see straight up front, the things that we would write about on each day. And that's going to make it a little bit easier for us to actually identify actionable trades or recommendations based on this. It's a very important time right now to be focusing on insider buying, as always, because as we note, these stocks over here are the worst of the worst, the stocks that are breaking down. Companies like KKR, companies like Blackstone, companies like Weyerhaeuser, they've seen insider buying in recent days. Executives are trying to call the bottom. But I will note this, if you look at this list of stocks, and this is important, you look at this list of stocks, and the insiders aren't buying, why would you? I'll leave you with that thought. I hope everybody has a great Friday. Thank you so much for joining me. I'm going to try to do this at least once a week, bring on some guests, and try to make this a little bit more exciting and appealing to everybody. I know this one went a little bit long, but we'll go from there. I hope you have a great Friday. Have a great weekend, and I will see you in March.